Hello again, everyone. I'm Nate Keenan. Welcome to the Mortgage Podcast. Another troubling aspect of the mortgage crisis are allegations that appraisers are pumping up home values. Most of us in the industry appreciate a professionally prepared appraisal because they make our jobs a little less complicated. So I might be a little biased that they are the latest group of people to be the target of finger pointing in this ever-growing crisis. Some people have been calling for stronger regulations to make sure that they do their jobs correctly. I find the targeting of appraisers a bit odd since they really don't have much leeway. Appraisal values are based on a formula relative to the sales of comparable local homes. The foreclosure crisis has been hurting home values as the problem continues its trickle-down effect. I think a major part of the problem was that banks gave out 2 or 3 year adjustable rate loans to people who bought homes with no money down. Once it was time for the rate to increase, the home's reduced value prevented the homeowner from qualifying for a new loan. When you deal specifically with these no money down adjustable rate homeowners facing foreclosure, it probably makes sense for the bank to work out a repayment plan for the homeowner because the home has no value if the bank takes it back. However, since this is only a temporary crisis, it would be reasonable to assume that at some point the home's value will increase. This brings to mind a very fascinating comment I saw on the news where a woman who manages an apartment complex that is across the street from new condominiums was amazed that rental applicants who were declined due to poor credit were pulling up in moving vans at the condo complex across the street after they were approved for a mortgage. I think we should realize that at some point the cycle of declining values is going to stop and home values will start to go back up again. But if the banks hold off on taking the no equity homes back and work out a repayment program, they will realize that these homeowners would prefer to keep their homes since it's unlikely that their damaged credit would even qualify them for a rented apartment. And if there is equity in a home facing foreclosure, why can't the bank restructure the loans to make the payments more manageable? Due to these problems with these risky loans, banks are getting much stricter when it comes to offering credit to buyers who are putting down less than 20 to 30%. Sellers who want to strike a deal for a high price that will ultimately increase appraised values are growing increasingly frustrated by prospective buyers who can't arrange the financing. For example, if a home is being sold for $200,000 and the buyer only has enough to put down to qualify for a loan on a less expensive home, sellers then have to decide if they're going to bite the bullet to take the lower price or hold out for more money from another buyer. What ends up happening is that banks are imposing stricter rules for almost all applicants, when in reality it is only a small percentage that have been delinquent in their mortgage payments. Everybody wants to see a higher value when it comes to an appraisal. The refinancing homeowner is happy to see his home's value has increased, and it makes it easier for a customer's loan to get approved. But before the banks start pointing fingers at appraisers' reports, maybe they should rethink stricter loan policies for people with excellent payment histories who appear to be getting punished for the financial problems of other people who the bank should never have loaned money to in the first place. For more information about this issue and others related to mortgages, feel free to give us a call at 732-586-1616. That's 732-586-1616. For the Mortgage Podcast, this is Nate Keene.